Imagine you are a retiree and the IRS is forcing you to take out money that you don't need from your IRA. It'll push you into a higher tax bracket, can cause IRMA surcharges on your Medicare premiums. It can even, in certain circumstances, make your Social Security taxable when it wouldn't be otherwise. Well, that's exactly what happens to certain retirees who are subject to take required minimum distributions who don't need them. And while you may be required to take these distributions, we're going to show you an example today of how we saved a client $12,000 a year by having them shift the required minimum distributions that they had to take and instead have them contribute to charities in which they were already planning to give. And stay with me because we're going to walk through exactly how you can do this too to make sure that you're able to take advantage of the strategy. And the best part is the IRS even encourages this. My name is Danny Sinowitz. I'm a CFP professional. I have 10 years experience in the industry. And what we're walking through today is one way in which you can actually save quite a bit in tax by just being charitable and changing your strategy from taking the required minimum distribution as income versus redirecting that instead. So depending on the size of your IRA and the required minimum distribution that comes as a result, you may find that the RMD is more than you actually need. And if the RMD is more than you actually need, you may be thinking to yourself, well, that's not really a problem, is it? Well, it can be because it can actually cause you to have some negative tax consequences. Examples being it can push you into a higher income tax bracket, specifically on your ordinary income rates. So your marginal tax brackets are going to be affected by the ordinary income that you bring in, and a required minimum distribution would be an example of that. Another example could be your IRMA thresholds or your Medicare premiums that you have to pay. Another example yet is Social Security taxation. The more income that you bring in or the higher your provisional income, the higher percentage of your Social Security benefit that's included in ordinary income. Now, that is capped at 85%. So maybe if you're already at that threshold, this isn't quite as big of a deal. But regardless, it can have negative consequences for taxpayers, especially if you don't need that required minimum distribution. And if you follow this channel at all, you've probably seen that we've talked quite a bit on RMDs and some of the potential solutions that can be included with them. But one thing we haven't gotten into in great detail is what's known as a qualified charitable distribution, otherwise known as a QCD. We recently were working with a couple who were charitably inclined. The husband recently started an encore career and was making enough money in combination with his and his wife's Social Security to cover their living expenses and their discretionary expenses. They had these RMDs that they had to take from their IRAs, and they really didn't have much of a plan in order to take them and necessarily pay the tax with them because they didn't need it. But with a little prodding, we were able to figure out that the couple had been contributing to charity and they were actually very charitably inclined. They had two charities in particular that they were very fond of, one in which they had been wanting to make charitable contributions to, and the other in which they were actively making these charitable contributions. And a qualified charitable distribution can make a lot of sense for retirees who do not need an RMD, but are charitably inclined. Now, these clients had been making contributions to the one charity with after-tax dollars, but being that they were utilizing the standard deduction, they weren't noticing any tax benefits from that. Now, they weren't making the contributions to the charity for the tax benefits, to be very clear, but if there was a way in which they could get some tax benefits and still contribute to the charity, they would have listened. Let's take a look at the situation had they had to take the distribution as income versus the qualified charitable distribution strategy in which they employed instead. And you can see for yourself the specific tax savings. So here's our tax planning software that we shared with them and gave them the different examples of what would happen in the tax year 2025 if they would decide to do this. Now, you can see here there's the pre-tax income side and then there's the QCD side as well on the different scenarios that we have here. We're looking at 2025 being the tax year that we're considering. And with the wages that the husband is able to earn from his encore career, it's about $75,000 that he's projected to make. So that's going to be the same in either scenario. We're not going to change that. But the IRA distributions that they're going to have to take are going to be right around $55,000. So between the husband and the wife's IRA, they've saved up quite a bit in pre-tax dollars. The $55,000 that they would need to take would show up as ordinary income. Rather, if they were decide to actually take this as a qualified charitable distribution, the IRA distribution shows up as zero. Now, if we scroll down, their gross Social Security will not change in either scenario. The taxable Social Security number is also not going to change in either scenario. However, keep in mind that with an RMD, if you're making less income, or perhaps if he was not working, what they could find is that their taxable Social Security could go up in the event that they're taking an RMD that they would not need, because as your provisional income goes up, so does the percentage of taxable income, again, up to 85% could be included in your taxable income. They also had $5,000 long-term gains, and this is going to be important. We're going to show why this actually was more beneficial to do the qualified charitable distribution for them. But as you can see here, the total income in the pre-tax scenario versus in the qualified charitable distribution scenario is $55,000 less, which is the RMDs. Now, again, you see that the adjusted gross income would be that same amount. They are utilizing the standard deduction in this circumstance. So their taxable income in the first scenario is $151,000. In the second scenario, it's $96,000. So as we continue to scroll down, you're going to see here that the total tax paid is over $22,700 in the first scenario, and it's under $10,500 in the second scenario. So it's an over $12,000 difference in total tax that's being paid. As you can see, the marginal brackets that are taking place there, it would bump them up to the 22% bracket as opposed to the 12% bracket. And their effective rate, it's about 4% less if they utilize the qualified charitable distribution strategy. Now, if you'll notice here, they also stayed within the 0% tax bracket on their long-term capital gains as well. The $5,000 of capital gains in the first example would have been taxable if they would have taken the RMD as ordinary income, resulting in $750 of federal tax. In the second scenario, that federal tax would have been zero. And we haven't really gotten into state income tax because there are so many different rules between each different state. But keep in mind, this could have an impact on your state income tax as well. So how do we actually make this work, and what does the actual strategy consist of? The first is that you have a proper charity in which you're able to make the contribution to. It needs to be recognized by the IRS as a tax-exempt charitable organization, otherwise known as a 501c3 organization. From there, they also needed to make sure that the custodian, otherwise known as the people who are holding the money of their IRAs, were able to complete this as well. Lastly, they also needed to make sure that they had the check sent directly to the charity. And again, that's in working with the custodian to make sure that they had the proper address and that everything was done on the up and up. So being that they couldn't deposit the funds into their own account and have it sent directly to the charity instead, they were able to make sure that they had all this information ahead of time and got this done in plenty of time within the calendar year to take their RMD, but do so to send directly to the charity. Something that can be lost in this, though, and it's not shown in the example, is that you don't have to give your full required minimum distribution to the charity either. You can choose to take a portion of your RMD and have that go towards the charity of your choice. So hypothetically, if they only wanted to give $20,000 of the $55,000 from their RMD, they could have done so. Now, the remaining $35,000 that they would have taken as income would show up as ordinary income. So make sure you plan accordingly if you're planning to just take a portion of it. But you're by no means required to take the full amount of your RMD and place it towards the charity of your choice. There are three last things that are worth knowing if you're planning to utilize a QCD. The first is that the maximum allowable limit is $100,000 per spouse. Now, if you have an RMD that's over $100,000, you probably have a sizable retirement account. That may be the case depending on how old you are and the size of your account, but the maximum that you can do in a given year is $100,000. In the example we showed, since their RMDs were well below this, they were able to utilize this strategy. But understand too that you can utilize $100,000 per individual in this as well. So both the husband and wife could have utilized $100,000 for each of their IRAs, and they would have been able to utilize this strategy for a total of $200,000 to go to a charity. The minimum age for a QCD is actually not the RMD age, it's the old RMD age of 70 and a half. So with the couple we were referring to were over the age of 73 when we decided to do this. The requirement isn't that they need to be RMD age, but rather over the age of 70 and a half. Again, being that they were over this age, it wasn't much of a concern. But if you're planning to utilize this, make sure that you're over the allowable age. And lastly, one that I think is actually most important and can often get missed is that the client's accountant wouldn't necessarily have this information provided to him or her unless they were notified ahead of time. The tax documents that would have been generated by Fidelity, or for any custodian for that matter, wouldn't show that it's a qualified charitable distribution. Instead, it would look like as if it was just taken as ordinary income in the year the distribution was had. So make sure that it's communicated with your accountant ahead of time if you're planning to utilize a qualified charitable distribution. That way, they can make sure that the proper paper trail is in place, and that in the event that you would get audited by the IRS, you have your back covered. The results of a QCD oftentimes are way more rewarding than just a tax savings. If you have a charity that you believe in strongly, and you want to make sure that they have the financial resources that you can help provide, a QCD can be a great way to make that happen. And again, it can also be a really cool tax planning tool as well to make sure that you're paying your fair share and nothing more. Being that the IRS actually incentivizes charitable giving, It's something that you really should be giving consideration to if you're already charitably inclined and you have an RMD that you do not need. And speaking of RMD planning, there are other strategies that you can look to utilize ahead of time before your RMD kicks in to make sure that that RMD isn't more than you need. One of those strategies can be a Roth conversion. And there are several mistakes that people make when completing a Roth conversion. But if you check out this video, you'll find out what the 7 mistakes are and how you can make sure that you avoid them and make sure that your tax plan is in the best shape possible.